How about now? Is that better?
That's much better.
Yeah.
That's much better.
Thank you.
All right, so I want to go around and have you guys introduce yourselves and give a little bit of a brief background about yourself and where you are in this multifamily space and why you feel like you're a good person to be here on this Raising Capital panel. And then we also want you to talk and share a little bit about how much capital you have raised to date with some of the projects that you have been a part of. So I will start it off with John. You going ahead and sharing first, and then we'll go to Julie, and then we'll go to Ryan, and then Mark, and then Michael. So it's kind of in that order. So just remember who you go after, then just go after that person. And then when you guys finish that, I will come back on and tee it up for the rest of the questions for the panel. For the audience, what I would like for you to do is find the Q&A box. And as we are going through this, we want this to be interactive with you as well. So I have some pre-selected questions which the panelists already are aware of, and they've been prepped on those so they can kind of be prepared for them. But if you have questions for the panelists, please put in your questions there as we go throughout the panel. So I'll let you, John, go ahead and take it over and take it away.
How you guys doing? Excited to be here. Thank you for having me. So I'm with Community First Investment Group, and what we specialize in is we've taken down opportunities with people and co-syndicated, but we also raise capital too. So that's what I'm here to speak on. And I'm actually here to speak on it on a kind of like a entry level coming in, because I had to come in and kind of work really hard for it and then get there. And now you guys are on an established panel. And I get it. I love it. I'm grateful to be here. And that's what I'm going to give you, the perspective from the entry level coming in.
Cool. Thank you. Hey, everyone. It's Julie Lamb here, co-founder, managing partner of Good Egg Investments. I have been in real estate investing since 2009. I got into multifamily investing as a passive investor back in 2016. So it's been a couple of years now. I moved over to the general partnership side of multifamily acquisitions and asset management about 2 years ago. And since that time, we've done a number of deals with our partners. So we've co-syndicated a bunch of deals, raised capital for those deals. And I'm here today to share my story with you in how very similar to what John had said, I had to work really hard. I didn't necessarily have a network of people around me that I could tap for equity. And so, I really started from scratch. And so I'm here to share that story with you and how you might be able to do the same and build, a group of investors around you who really believe in you and, want to invest with you. So over the last 2 years, I did my first deal on the GP side. We've raised a little over $10 million. So that's my story.
Great, Julie. This is Ryan McKenna, founder of McKenna Capital. Kind of similar background, got into real estate investing 2006, kind of dipped my toe in the water with some single family rentals. And then around 2016 was when I really started investing passively in multifamily syndications, and have done a lot of deals since then. But the capital raising portion of my business has really been about 18 months since I started that. And that was really kind of predicated around, me doing some investments on my own, but expanding, my network, friends and family, others that were interested in doing what I was doing. And then now kind of, building a business around showing them how they can invest in these opportunities as well. So it's been great from a networking standpoint, but also just to see the business grow and to be able to invest in a lot of deals. And it's been kind of a fun ride. We've been very, very busy with everything. And we basically provide, we're co-syndicators as well. So we provide opportunities to invest in multifamily syndications. We've done self-storage and manufactured home parks as well. To date, we've raised over $25 million and done about 21 deals. So been very active, and it's been great working with a lot of investors out there. So any perspective I can share on just how I started from nothing 18 months ago, not even knowing about this portion of the GP, being able to help from that perspective to really getting very involved and just doing multi-million-dollar raises, kind of deal after deal. So it's been kind of a great run, and looking forward to learning from others as well. As I'm just happy to be here and to participate on this panel.
Cool. Mark Kenney, Think Multifamily. I started buying small multifamily in '93 when I was still a senior in college. I didn't know what syndication was at all. Started looking at it in 2013, 14, started actually kind of syndicating, done a little over 5,000 units since then, raised, I don't know, over 50 million, and learned a lot of, kind of being here, learned a lot of tough lessons along the way, frankly. I was really petrified, felt scared and raising money at all. But there's definitely some things you can do even as a newbie to help you make it easier. It won't be easy necessarily in my mind, but it can potentially be easier than if you didn't have a little help.
My name is Michael Blanc. I'm the CEO and founder of Nighthawk Equity. We have about 1,300 units. Some of them actually we have with Mark. We've worked also with Julie and her team on these things and raised about $20 million directly, and also through joint venture partners like you guys have mentioned as well. We also teach people how to do this, kind of like Mark does as well. How do you actually syndicate? How do you find the deals? How do you raise the money? And so I'm really excited to be able to learn from you guys here and maybe be able to contribute to how do you go about raising money.
Great. I had to step out for a quick minute to shut my door because all the sessions were going on at the same time around me. So had a little bit of extra noise. So
Dan, there's a chat too saying they can't see Michael.
You can't see Michael. I see him. I don't know. Well,
you know what it might be? Maybe expand the screen too. Maybe someone has a screen.
That's probably what it is. Because if you lower the screen a little bit, it might cut somebody off a little bit. Yeah. But we can also do it. You can also change the speaker view too to just be the person who's speaking too. But as long as you can hear Michael, that's the most important thing, right, Michael?
That's right.
I can see you, Michael.
So I did my hair just for this.
I see that. I like it.
Yeah.
High and tight.
Awesome. So I'm going to have you, the last summit we did, we had you kind of go in a certain order. And this time I'm going to have you guys just kind of jump in as you guys feel like you can provide and share on the various topics. And the first question that I want to present to you guys is, what do you think for somebody who's new would be the most foundational or the most important foundational thing required for someone to have in order to be able to begin raising capital?
You mind if I tackle that first, guys?
Sure.
So coming in, it's crazy because you kind of tend to look at everybody as a dollar sign, and you kind of want to escape that. The further you can get away from looking at them as a dollar sign as a potential investor, then the more likely you could build a relationship with. So that's something I struggled with early on. And I think you guys can probably attest to that because you just want to kind of raise capital and you're so excited about it and they see the excitement in it and in it through you. But at the same time, you're not giving them a chance to kind of build a rapport because it's all about trust at the end of the day. So that's the biggest thing. What about you guys?
Yeah, I would agree with that. I was going to say the same thing is like, don't go out there with an agenda. I'm going to have to raise money. It's really how do you build relationships and that comes first. And the raising money may come after that. But really the way I do it and I advise other people to do is just to share your enthusiasm about this thing. Hey, I'm so excited about the apartment building thing. I've gone to a seminar. I have a coach. You're not going to believe this and la, la, la. And then if they get interested in that, then you can continue the conversation. The only difference is you have to be intentional with your conversation. So, don't talk about politics and the weather and sports when you're out and about. Get it over with. Share your enthusiasm and direct the conversation in a gentle way, depending on who you're talking to. But John's right; it's really about building relationships versus going out and raising money.
No, I'd say for sure. One just kind of quick comment though too. I'd say before you start raising capital, make sure you understand the legal aspects of it. What you can and can't do. It's not difficult, but there are definitely rules of can do some things you can't do. The other one I think is, yes, relationships, but it's the action afterwards. So I guarantee people listening to this right now that go to events and have a stack of business cards on their desk right now, they spent, whatever, maybe a couple $1,000s to go to an event, travel, things like that, their whole entire weekend, come home and literally haven't followed up with one single person from the event. That's your easiest target. You've already put the effort in to go to the event, collect cards, meet people. If you just follow up, you're further ahead than 95% of the people out there in the world.
Yeah, and I'll follow up with that. The way I really approached it was certainly, about building relationships, but really for me, it was about adding value. It was about telling people about my experiences and the information that I learned as a passive investor and how I looked at deals and how I was generating this 8 to 10% return and what that meant for me and my family and how it was really changing my life. And so that was really how I started and initiated conversation and sparked that interest from people I really didn't have a relationship with at all. And it was that was kind of like the foundation for me in a lot of relationships in the early days, where it was just like, hey, this, I invested in a deal a couple of months ago. Here's my experience. Here's what I looked for. Here's why I invested in the deal. This is why I love the market I invested in. And, really just shared my experience and added value and gave as much information as I could. And, to date, that's still exactly what we do. I had a call yesterday with an investor and she was just completely blown away. She's like, wow, I've already invested with another group, but just spending 30 minutes with you on the phone, I feel like I've, received so much more information with you than I did, with the other group. And it's just like adding as much information and value as you can so that investors feel like, you're a thought leader and you're someone who is, an expert in the field. And so it's really about positioning yourself in that regard as well, I think.
Yeah, I was just going to say real quick on that too, Julie, is that, if you don't have the experience, a lot of people don't starting out, then partner up with somebody that has experience. It's, people in their mind think, oh, I'm giving something up by bringing a partner in. Well, 100% of zero is still, zero. So partner up with someone who's done it before, leverage your track record, their story. And it's okay to say, hey, I don't have much experience yet. I'm one member of a team, and, whoever is an experienced person, been doing it for 20 years. So it's important to have someone else you can rely on other than yourself.
Yeah, one thing I wanted to add too is just kind of all on the same theme here of relationships and your network. But like Julie said, I mean, I share experiences. Before I got in raise capital, I was investing in these deals passively myself. So I knew kind of what the deals look like, how to talk about them, my experiences, and so I could share that with someone that has questions and wants to know what this looks and feels like. And so my approach was always, this wasn't a sales pitch. This was an opportunity just to share with someone about something I was super passionate about, that I felt really good about. And at the end of the day, I looked at this as, I hope they would have thought of me as someone that they would want to share an opportunity like this if they came across it. So it was really no pressure. It was just, hey, let's sit down, have some coffee, and I want to just chat with you about what I'm doing. And so I had a lot of initial conversations like that, well before I had my first opportunity. Just with people in my network, I was just planting the seed, letting them know what I was doing. So when the opportunity came around, it wasn't like I was striking up the first conversation about this. So it just kind of felt more natural. And I think kind of maybe planning ahead with your network. And if you can start by first investing in deals yourself, I think that gives you a little bit more credibility, but you can also get that by partnering with others as well. So that's just kind of my personal experience and kind of what's worked for me so far.
Yeah, I'd say passive is great. I mean, I started passively too. And I think, you're a partner in the deal. Yeah, you're a limited partner, but it's okay. I met a guy in Atlanta and he's in a couple deals and he's like, well, I don't really have any experience yet, and then, 20 minutes later, he's like, I've invested in like 400 units as a limited partner. I'm like, you can leverage that as part of your story, right? You don't, if someone asks you, hey, are you a general partner? You can say no, but you can say you're a partner in 400 doors, and that's a true statement. So don't downplay the experience you do have, or if you have a profession that's well respected, whatever it might be, that's something else you can help leverage too.
So let's pivot to another question that I have here. In your opinion, do you feel like you need your own money to invest in your deals before you begin raising capital, or having, if you're raising capital for another group, should you be one that's invested in one of those in that particular deal as well? What's your opinion on that?
I mean, I think it certainly helps. That's a good sales pitch to be able to say, hey, I've come before you and I've already done this, and here's my experience. But I don't know that it's absolutely necessary, but I do think it helps.
Yeah, I would say it helps for sure, but if you're doing a ton of deals and I mean, I don't know how many deals, Julie works with other people on a deal, but if you say you're doing 8, 10 deals a year, that can be a lot of capital you have to invest, right? And then people will say, well, yeah, well, you're getting an acquisition fee, you're only investing that. Well, yeah, but people have a job, and this is our job, right? We get paid for our job, so we're using money from our job to pay to invest in a deal. Some investors won't invest in a deal if you don't put money in. But I think it comes back to the trust piece. You think I'm going to react differently if I have 50 grand in a deal than if I have 0 in a deal? Hopefully not. Hopefully we react the same way. But I don't have a strong opinion on it. I can tell you it comes down to what the investors think. And a lot of investors want to have money in the deal, and some investors could care less. So
yeah, and I would add to it that I try to invest in every deal that I can, but when you are doing a lot of deals, sometimes it is difficult from a cash flow standpoint to just have everything, available at that point in time. And so, yeah, the intentions are there and you try to do the best job you can. But I think if someone's, questioning whether you're committed or not, I mean, I left the corporate world 3 months ago. I left a very lucrative job to pursue this full time to help more investors invest in great opportunities. So I'm 100% committed, walking away from a lot to build this. And I think they would understand that, look, I'm trying to do my best to invest in every opportunity I can because I believe in them. But at the end of the day, I mean, the money does add up, and you're putting a lot of money out there, and sometimes the timing just doesn't work for you, but that doesn't mean it's a bad deal or that they shouldn't invest in it. So that's kind of my take.
Yeah, I agree with the timing aspect, because you might have something coming back to you, but it could be a couple months from now and you don't have it right there, but you can contribute to a deal by raising capital. Absolutely.
I agree with everything O said.
What I was going to tie it up here and just kind of say that, I think in a perfect world, yes, we should all invest in every deal like that. But like you all have said, it all depends on the timing. And, when you're putting these deals together as well, I mean, there's also liquidity requirements that you have to have from the lender's perspective. And so depending on the size of the deal and how much money you have available, it can sometimes get tied up from that instead of having to being able to invest in all the projects. So great answers to that question. Next question here is how do you manage your investors? So what kind of things do you use resources wise, or systems or processes do you use for your investor relations? So, once somebody comes to your website or reaches out to you, or you meet them at a conference, what's your process in the back end look like from a follow-up standpoint?
Before or after the investment, Dan?
I would say both.
All right. Okay. I'll go first. We can spend probably an hour talking about this as well. That's why I asked you if it's before or after, right? Julie's already laughing.
Yeah.
Spend a half hour on before and then a half hour on the after. So, all right. So before, really, this goes back to what we were talking about before, is you want to continue, you want to engage the investors, but you also want to provide value. And so that's kind of our approach. I know, Julie, that's what you do. And all you guys, really, you're providing value, you're providing content. Maybe you have a blog or videos of some sort, and you try to engage your investors and you try to make them comfortable with you until the point where you have a deal and you can present them with a deal. And once you have that, there's various software that we can use to onboard them. In the beginning, we did it with spreadsheets and manual. And today we use, something called CrowdStreet or IMS or Investor Deal Room, or different software that are used to make it easy, to make the onboarding easy. You manage the process. The deal gets out. People can, quote, make an offer. They can DocuSign the documents. They get the wire instructions. So it's kind of a workflow that we have. And then on the back end, it's very important that we put out regular reports to the investors, in addition with the distributions, especially after you close. People want to know what's going on. You've been silent for 3 months. Are you guys still there? And they start freaking out. And so you can use these portals in a way to communicate with them, to provide them status updates, to provide them financials as well. So that's kind of the process on the quick, I think.
Yeah, I just one quick comment. Excellent. I agree. I think the one thing I would add is that pick up the phone. Right. You need to get on the phone with them and talk to them. So you can put them in your funnel. And I have found, this isn't to be, mean or anything. If someone fills out a questionnaire after they say, hey, they're interested in investments, or it might be, and they say have $5,000 to invest, they're going to probably go pretty low on the list. It's not, you just have to prioritize, right? End of the day, you can't call every single person that reaches out to you, but The ones that look like they're maybe interested in actually investing, someone's invested before is even more of a candidate. I'd make them a higher priority. You need to pick up the phone, talk to them, understand what they're looking for. In some cases, you need to do that anyways from a legal standpoint. I won't go into that aspect, but just pick up the phone, talk to them.
Absolutely. From a kind of like I would put the early stages is we have MailChimp. So if you go to a website and you submit the form, we follow up with the email, try to get you on a phone call. But really the touch point really is the phone call, like Mark said, because that's the most important. I feel like I'm more effective on the phone than I am via email, blog, or anything else. But I like to keep in contact with various blogs or newsletters and stuff. On the back end, once a deal closed, like Michael says, you follow up and let them know. And it depends on the type of project. You might want to be in touch with them monthly or quarterly, like Michael does.
Yeah, I would say for me, when an investor signs up on our website, I have it kind of automated through MailChimp. But the first thing is to set up a call with them, and I have I use Calendly for that. So there's an easy link to my schedule, and they can set up a 15-30-minute call, and we can get to know each other, talk about their investment goals and kind of what they're looking to get out of potentially maybe an upcoming opportunity we might have. And so we just begin that dialogue, and then obviously if it makes sense to kind of keep talking, then they'll go into our distribution list so we can kind of share things that we're working on, updates. We have a monthly newsletter, we have blogs that we're putting out, and it's just a way for us to stay engaged. And I always try to make myself available anytime for a call or if they have questions over email. But MailChimp has really allowed me to streamline what we do and be able to, once the investor is qualified, to share everything that we're working on in a very efficient manner where I can put together kind of one template for a particular deal, and it can go out to many investors. And we just kind of process built for when we take soft reserves and kind of track all that. And then once a deal closes, then it's usually monthly communications coming from me, and it's all managed through MailChimp, and how the deal is performing and just kind of the latest project updates with things that are going on with that apartment complex. And it's a great way to stay in contact, and it's pretty easy once you get it set up, and it allows you to really scale your business.
So
yeah, I'll just add that our funnel is very similar to Michael's funnel in that we prioritize the education and the adding value. So if you go to goodegginvestments.com, you'll see there is a ton of content on there in the way of videos and blog posts. And, for us, that's really the beginning of the relationship, and really getting to know us is, learning who we are through, blog posts and videos and adding that value. So that's really where they start to get to know us. I would say another place really where the relationship starts too is being on others' podcasts, and then people hear us on those podcasts. And then by the time, they move through our funnel, they go through our website, they sign up, and they, move through filling out a form and then setting up a call. By the time they actually jump on the call with me, sometimes I have people who are just like, I'm ready, I'm there, I'm already ready. What's the next steps? And I'm like, whoa, we need to, I need to learn, a lot about me, which is great. And that was the intention, but I need to now take the time, like Mark said, to hop on the phone and get to know the investor. I need to know what their goals are. I speak to every single investor. There is not one person in our database that we send deals to that we do not have that kind of relationship with. And we spend that time getting to know them. And then, very similar post-closing, it's just monthly updates after that where we talk about where we're at with occupancy, whether or not we're meeting the projected rental premiums that was discussed in the investment summary. That's a very important piece that I think should always be included. We talk about where we're at with our rebranding. Most of the properties we buy, we're doing rebranding on those properties. And then any news about the submarket that we're investing in, we also try to include as well, just to kind of, keep investors upbeat about the market and the deal that they invested in. So, yeah.
So I just want to add one thing. What's really important, I think what we're skimming over is you need a way to capture leads. Okay. So yeah, I agree with you, Julie. Go and podcast, but if you don't have a way to capture leads, you're wasting your time because you have no way. As a listener on a podcast goes, oh, let's go to Good Egg Investments, whatever. And then there's no way for you to capture that visitor. And more importantly, you need something of value to give that person in exchange for the email. So it's not enough that you take out a Facebook ad or get on a podcast. You need something, that's of value, that is free. So they'll give you your email address. So in your case, Julie, you guys have, Investing 101, like this, 7-day course. We have a free report, something of value to the investor, and that begins the engagement process. And so make sure that before you start, going capturing leads, that you have a way to capture those leads when someone actually comes to your website.
Yeah, one quick one on that too, to follow up on Michael's, is when you're capturing a lead, I would ask for as little information as possible up front because they're not going to give it to you. You can follow up with a more detailed form, but don't ask them 10 questions. Even if you're giving something of value, don't ask them 10 questions, in my opinion. Ask for a name and maybe an email, and that's it.
Yeah, and that's a good point. I mean, in my mind, there's 2 tiers. There's the free download thing. All you need is an email. If you ask for a first name, your conversion goes down. Yeah. And then the engagement process begins. And the next engagement for us is, like you guys, why don't you, join our club, our investment club? And at that point, we can ask them a little more information. For example, we ask them if you're an accredited investor or not, because the behavior from a legal perspective changes. If someone says, I'm an accredited investor, I can immediately show them a deal if we have one. But if not, I really want to engage them in a conversation and a phone call. And so we handle those people differently. And you may have some other criteria as well, like, are you a citizen? Yes, no, that kind of stuff. And so you get more and more information the more someone gets down into the process.
Yeah, just to clarify one point Michael made, and I know he knows it too. You can show them a deal if you're doing a 506C. So just to clarify, Michael says you can show them a deal. You can show them a deal if you set a structure where you can do accredited only. So just wanted to.
Yeah, thanks for that.
Just to piggyback off that, if you have no system set up and you're coming off a conference and you got a stack of cards, put it in a spreadsheet, follow up, start basic. That's all where we started from. And then we built up to as we learned systems. So just consider that as well.
It's good.
So I'm going to want you guys to take this opportunity because we're all talking about follow-up systems and lead generation. Would you go through and also share with us how, if somebody's watching right now, we can go and see what you guys are currently doing, whether they want to jump on, some of your lead stuff that you have or whatever, share how somebody can maybe jump on your list as a passive investor or whatever.
That's a great idea. And even if you're not, you can kind of see what's happening. That's awesome. We're at nighthawkequity.com. So you click on the join button and you'll see a short form. The report I'm talking to is, where is that? I don't think it's live yet, except it's at themichaelblank.com/report. And that'll be integrated into the Nighthawk Equity website. So those are 2 ways to see kind of what we're doing.
Yeah, and for us, you can just go to goodegginvestments.com and very similar, just click join and you'll move through the funnel process that way. And you can also, we have a little lead, if you will. It's, when you go to our website and it's just like a 101 coaching program, really quick thing that my business partner, Annie, will run you through, and you can put your email in there, run through that and kind of see, how she, does her little pitch there as well. So.
Yeah, and very similar here. You can go to McKennaCapital.com, and that's how we can begin getting engaged. We have an investor distribution list that you can join, and then that usually starts the process of, starting out with a phone call and then, talking further from there.
ThinkMultifamily.com for us. Same, you can express your interest in investment, coaching, where it might be, and then fill out that email.
CFIGwealth.com for us, and our site is currently down because it's what a week we're choosing to roll it over.
It happens. It happens.
Yeah, but we'll have we have a capture lead form as well. So there you go.
All right, great, awesome. And for those of you who are watching here, I also in the chat box went ahead and as they were sharing their websites, I'm familiar with all of them myself, so I went ahead and typed in their website addresses so you guys can have those, so you get the correct spelling and links and stuff like that. So feel free to use some of that as a resource, and Swipe and deploy is what I say. So don't directly copy, but you can use it as like a guide or a template and kind of, mix and match a few different things and a few different ideas. So we definitely don't want somebody else looking at our website and going, oh, copy the exact same thing. It doesn't look good. So I have a question that's come in from Neil, and it has to do with the one of our first questions we had about kind of building relationships and having that foundation built. And so his question is what are some empowering questions that you ask your new relationships that you have in order to be able to build those relationships into wanting to be able to kind of merge that relationship into the multifamily space?
I like to get a feel for their background. So it's mainly just kind of being genuine and, just try to learn more about them. That's all I can offer on that one.
Yeah, I'd say what they invested in before, what they liked about it, what they didn't like about it, or they say, hey, my uncle invested in apartments, did horrible. I'm trying to understand. A lot of people think they are okay with more risk than they are, frankly. And then they'll find out, okay, so understanding what type of deal, if you said, hey, if someone says, I'm looking for cash flow, and you have a big value add deal that have cash flow for 18 or 24 months, then that's not, even if they say, well, yeah, I'm interested in that deal, it's probably not a good deal for them. So really understanding what they've done before, to John's point, and what they're looking to do in the future. In some cases, they don't know yet what they want to do. So you have to kind of help guide the conversation.
Yeah, I would say that it's a lot of it too is just understanding what people's pain points are. Where I had started was talking in a lot of local mothers groups, and as mothers, what do we need more of? Time, right? We don't have enough time. We're busy being mothers, having a career, running the household, doing so much. And so I kind of already focused on a particular niche, and I already knew what the problem was, that there was a lack of time. And I think that holds true for, most of the people that we work with who are accredited investors, right? They just don't have a lot of time. And so that's I think a good place to start with, just having that understanding and just knowing that people have a lack of time and maybe want a little bit more freedom in their lives, and using that as the foundation and the guide to kind of start guiding your discussion.
Yeah, in my case, usually when an investor reaches out, they've typically done some homework, or we've captured them in some way through the sales funnel. So there's an interest of wanting to learn more and potentially invest. So I try to find out, the experiences they've had. Have they done this before, or is this just something they've heard about? Just to kind of see, what their experience level is. But then also going deeper of, a lot of these investors have money in the stock market, and so you're having the conversation about the difference between that and, investing in real estate syndication, and then even going one step further, there's some of the tax benefits that come into play that a lot of people are, that may not know about it, but they're very interested in hearing how some of our deals are structured, some of the other benefits. So try to kind of capture all that. But I also, at the end of the day, I let them know that these are illiquid investments. The last thing we want is someone to put their money in the deal that, next month they need it to pay their mortgage, or, they're going to be unhappy if they don't get a good update. And I just let them know up front that they're not going to be a good investor for a good fit for us if they're, looking at this as like the stock market where they can, press sell and 2 days later get their money back. And so I'm very upfront because I think they need to know that. And most, get it. That's why we have kind of some outsized returns compared to the stock market. But in return, you are in a little bit more illiquid investment. So I just want to make sure that is, front and clear for them, so that going forward, that you're not getting those, daily calls or updates of, hey, how's my money doing? This is a long-term play for all these deals.
I think in the beginning, you tend to take any investor that comes along and wants to invest. But there's a problem with that. And I think Ryan just kind of hinted at it. And so at this point, as soon as you are able, you really want to qualify the investor and kind of take more of an advisor role and how to kind of have their best interest in mind. Because if you're taking someone's last $50,000, so they have the cash to invest, but are they really the right person? And what happens is, if they're not, they're going to be a pain, right? Yeah. And if something were to happen, go sideways, they're going to be the first to call up their attorney. And so, maybe not accepting their money up front, maybe helping them understand the investment a little bit more, or simply trying to talk them out of it. I mean, we sometimes try to talk them out of it. And so really trying to understand what they've done, like Mark said, and what they want to do. Is there a fit? And sometimes you might just say, you know what, there may not be a fit.
Yeah, it's good.
All right, so let's move on to a couple of questions that are starting to come in through the Q&A box here, and we'll pivot back if we need to some of the other questions. I have one I'm going to wrap it up with towards the end, which we still have a good 40 minutes left here. So there's always this question about preferred returns, okay? Like, should you do a preferred return? Should you not? And Ruben's asking a question of, are you finding that your more sophisticated investors are wanting that preferred return?
Without a doubt. For us, without a doubt, no question about it. We've done both. We only do preferred now, and as a syndicator, I would rather not do a preferred return, frankly. I'd rather have a clean split. But a lot of the investors, we had a number of investors that would say, hey, especially the ones that are a little bit more sophisticated or have a little more capital, would say, I won't even look at your deal if you don't have a preferred return in it. So it all depends on your investor pool. Before, our investor pool was okay with it, and then it became more and more people that were outside some of these groups, if you want to say, just your average investors that have invested over the years. And for me, they've expected preferred returns.
Yeah, for us, it's not something that's expected at all, but it's certainly something that I use in my conversations with investors as sort of a sales pitch. It's something that I think is really important. When I started out as a passive investor, I absolutely wanted the 8% preferred return. And I was very same way. I wouldn't look at a deal unless there was. It just didn't make sense for me. I wanted to make sure that, everybody's interests were aligned. And so, when I talk to investors, I let them know that every single deal that we do, with exception to a few, all have that 8% preferred return built in. And I think that gives them a certain level of comfort for sure. But I wouldn't say that they necessarily seek that out. So
a lot of investors don't understand it, right? I mean, the average investor doesn't even know what it is.
Right.
Yeah, that's right. We have never done one, right? And I don't think it actually aligns us with the limited partners. Here's why. What I say about it. If you give a preferred return, if the project doesn't go exactly the way you planned, and you start getting into deficiencies, meaning that you can't fund that 8%, what happens is it defers to the next year and accumulates, and so what happens is the general partners are catching up sometimes to the deficiency, especially when there's a value add and for some reason there's a problem with the deal. If that goes on for too long, the general partners realize that they'll never get paid on this deal, ever, because they're always catching up to deficiency. And I just think it demotivates the team, in my opinion, to do that. Now, is it easier to raise money with a preference? Clearly. And some people insist on it because it's easier. Now, we have done it without it. In fact, I had a conversation recently with Reed Goosens and Joe Farrells, and they're trying to wean their investors off of their preferred because they recognize that the returns are lower. They have to buy deals at slightly lower returns if they want to get deals done, and they feel like they can't satisfy that preferred return. So again, pros and cons. I'm not saying one is right or another. There's different points of view on that.
And it can be lower. It doesn't have to be 8%.
Yeah, and I've seen 7-8%, but I've also seen deals without a preferred return, and I feel like, in today's market, we have seen a lot more of the preferred returns. But I've personally invested in several opportunities that didn't have a preferred return. And me as an investor, I was looking at their track record and their performance and how well they've done over the last 15, 20 years. And they started out with a preferred return, but over time they had really happy investors that just kept reinvesting, and that preferred return went away. And it became less and less of a, issue because they were looking at long-term, how well they were performing, and that it just, if you wanted to invest with them, this is just how it was going to be. And I think, some groups that's just how they operate. And so each deal is slightly different, but I don't think it's, if you have it or not, it's going to end up, making or breaking an opportunity for some investors.
Yeah, you guys all provided all the great right answers and all, but there's no but, sorry. We had a preferred return on ours as well, and it helps raise the capital. So
a couple things that I'll add onto this as well, just because as my wheels are spinning, I'm coming up with some things. So I would say that, kind of what Mark was saying, that I think, a couple of years ago, it wasn't as prevalent as it is now. And so a lot of times these investors are on, lots of different people's email lists, and they're getting various deals. And so sometimes they're making decisions as to, do I want to invest with this person because they do have a preferred return, or with this person because they don't? And I think going back to what Ryan said, it really depends on the deal, like the operator and things like that. But I think it also, when you're talking about that preferred return, I know, Michael, you had mentioned that it rolls over to the next year, but you can also set up the offering to do a non-cumulative preferred return. So even if you don't hit it one year, it doesn't roll over to the next year. So the next year, if you had an 8% preferred return and you only got 6% that year, you don't have to do 10 the next year. It just resets every year back to that 8% or whatever that number is. Obviously, investors will, if they're savvy enough, they'll look at that and they'll ask that question about, do you do cumulative or non-cumulative preferred returns? But I can definitely see when you do when you do a cumulative preferred return, if you are buying an asset that might be a little bit underperforming right now, and the deal is dependent upon whether or not you get that asset performing to a level that you projected, and sometimes those returns can go below that preferred return, if you will, and then you have that cumulative, then you might that next year be 10% or 11%, and then you miss it that year. Now that rolls over to the next year, and so by the time you're done, you're having to do 15-20% return back to your investors before you as the sponsor, and it can be very, like you said, de-incentivizing for sure.
Yeah, I've also seen delayed preferred returns, probably like starting in year 2 as well. So yeah, you bring up a great point on that one too.
I think one thing that would also help investors from a preferred return standpoint, if you were not going to do a preferred return, is to, and I've seen some groups do this where they don't do a preferred return, but the sponsorship does not get any return until the initial capital of their investors has all been returned. So they really save their portion of the return until the sale of the asset or some sort of a refinance as well. So there's definitely different ways to structure and different things like that to continue to align the interest with the investors plus the sponsorship team. Along these same lines, there was a question that came in about this same topic here. Okay. Do you structure your deals where you your deals where you solely own the property going forward after a refinance?
That's so funny. We've talked about this for a while. It's like, so the question is, hey, if I return all the investor's principal back, did I cash them out? And the answer is no. And we had a conversation, even Mark and I, a little while back. Is this doable? And the answer is yes. You can do anything you want. And then the next question is, well, does anybody do it? And the answer was no. No one that I know has actually done it. And the consensus was that it just leaves a bad taste in investors' mouth. What happens instead is in a cash out refinance, even if you return all the principal back, if there is a pref, obviously that goes away, but the investors retain their equity in the deal. And so now their return is infinite, or if they have maybe 20% left, their cash on cash is really high. It makes them very happy. Now they get their money back and they invest in another one of your deals and get a return on that money. So really what it's doing is it's being, by some measure, overly generous. But really that's how you build your business. Is you really want to make your investors super, super successful so they keep investing with you and tells a friend about it. So you can do it if you want.
Yeah, I tried it on 2 deals.
What happened?
And we did it. I mean, we did it actually. We were able to raise. One was a big raise too, but it was 125%, equity plus 125% return over a 5-year period. Then we could basically own it outright. And I had investors in an uproar, essentially. And
you disclosed it to them up front, I'm sure. But then when you actually exercise, people are like, "What are you doing? What are you doing here?"
Yeah, it's crazy.
We'll leave that one at that, I guess. No. Any other comments on that one?
I mean, I've seen it before, but it's been on some smaller deals, and I love being able to tell an investor, no, you're going to keep your equity position. You're going to continue to keep receiving distributions, and when it exit at some point, you're still going to receive returns. So I think that's just a much better way to have that investor alignment. And also you're thinking more long term as them as an investor in multiple deals versus like I feel like if they're not aware of this, they might feel like, I don't know, that it's kind of one-sided, or could be, and that feeling, because I've had other investors that have asked me, they've been in those deals that they're like, yeah, I just wanted to double check because, I don't want to invest in a deal that's kind of structured that way. So I think, long term, I think it's a good thing because the money will come back many times over if you have happy investors out there.
Yeah, I've spoken to investors about not that they've asked if they stay in the deal once they get their original investment back, and that's an educational thing. You bringing them all, you're stringing them along and educating them on that. But I've also told them about IRR hurdles. So if they get 15% IRR and we meet that, that's usually on the back end. It might jump to a 50-50 split. So I'd rather do that than cashing them all out.
The waterfall.
On the same topics of different structures and stuff as well. Chad has a question here: is would you ever offer a preferred return for certain levels of equity to encourage larger contribution versus non-preferred if that threshold is not met, or maybe a stair-step return depending on equity contribution? For example, 1 million is 8%, 2 million is 9%, etc.
It's a great idea. I've invested in deals like that myself, where you put in whatever it is, a minimum. It's usually higher, right? It's not like 100,000 to, it's usually going to be at least probably 250, generally speaking, from I've seen, and sometimes higher. But you get a higher preferred return, and I actually got a higher split on the equity. It was 40%. So it's it's a good idea. But you have to have, if you don't have, your investors don't have that much money. If you're dealing with a $50,000 to $100,000 investor, is it beneficial or not?
Yeah, I would agree with Mark. I mean, I've seen it, and it's great for certain group of investors that can invest, those types of, amounts. And they typically know about that too, because they're generally going and approaching you to say, look, if I put in 500,000 or $1 million, I want a better deal. And so, but yeah, for your average investor, it's usually something that doesn't come into play and can be confusing if you have kind of too many, different arrangements from, who gets what in a deal. So, yeah, I definitely think it's great. But it's all depends on kind of who you're targeting and who your investors are as well.
Good. And one last question along the same lines is, do you typically require a $50,000 minimum in your investments, or are there different scenarios where you might have a lower investment that would be considered?
Yeah, I think some deals that we do, as long as you do an initial $50,000 investment with us, then like subsequent deals, you can do a lesser investment. Yeah.
I would say
we start with some of ours at 50, 75 or 100 minimum, right? Michael and I we did 100 on one, and it's harder, but the minimum is typically where a lot of people will invest. So if your minimum is 50, that's where people put in typically. So. And
you can always make an exception. Someone kind of growls.
I would agree. I'd rather do exception based, frankly.
Yeah, you don't publish anything less, because if let's say you publish, what are you going to do? 25, 30? You're going to attract a $10,000 investor. You don't want that.
Yeah, where I've seen it is typically the minimum's 50, and there can be flexibility in certain deals or maybe repeat investors, and a lot of that just happens to be based upon how the sponsor wants to set up the deal. I haven't seen a deal higher than 50. And I know just a lot of my investors, what they typically like to do is they're trying to build their own little private equity real estate portfolio. So they want to take positions in many deals. And, if they're investing $50,000 a deal and they're doing, 5, 6, 7 deals, that, adds up over time. So I think every once in a while, it's nice that, they can get in for a deal at 25 just because, maybe from a capital standpoint, that's all they really have, but it's not like the deal is marketed at, hey, everyone can get in at 25. It's typically 50, and sometimes we have flexibility and sometimes we don't.
Yeah,
absolutely. Start at 50 and make the exceptions as you get closer to the raise, to completing the raise. Yep.
So let's pivot here to another question that we have from Devin. His question is about your top 3 key pain points where you have to spend most of your valuable time on, and how are you seeing those pain points getting easier now that you're raising more and more money for your various projects?
Pain points always time, always. So it's whether it's on a call with an investor that's supposed to be 30 minutes that runs an hour, because it's just the nature of the conversation and the way it goes, and I don't have nothing lined up behind it. but also it's time and connecting. And with my team, I'm doing all the people-facing things, whether it's brokers, investor relations, PM. That's all I'm focusing on. And I bring everything to the table, and I build systems for my teams to throw it in Podio, and they go ahead and analyze and then go from there. So with me, it's time.
For us, about 12 months ago, it was lack of engaging investors. So people would stumble on this form, sign up, and then never hear from us again because we just weren't focused on it. And I think, like you talked about earlier, one of the most powerful things you can do is to get on the phone with these investors, right? They really want to hear from you. But we weren't doing anything. We weren't sending them an email. We weren't doing a phone call. They just were on our list, and that's about the end of it. And so that was our state of affairs last, about a year ago. And so the way we solved that is by bringing on someone that's focused on the investor. So we have someone that's focused on investor relations, and all they do all day is get on the phone with people. And then we also have a back-end engagement process on email, and where we provide content, and we try to provide that value. And so we have made progress towards that goal. So when someone gets on your list, you got to engage them. You got to provide value.
I would say that for us, it's very similar to what John mentioned, which is time. That was a huge pain point. I was spending hours a day talking to, only a handful of investors, and then how many of those investors actually, turn around to invest. So it's how do I get, the good quality leads, and then how do I get, convert those leads into actual investors in the shortest amount of time possible. And so, again, for us, a lot of what we focus on is adding value. And, the different ways that we do that is through getting on other people's podcasts and educating, creating the blog posts and creating videos. And so by the time an investor actually gets on the phone with me, which then we actually have a funnel set up. So, and I use Meeting Bird, and we have a whole funnel set up. So by the time I wake up in the morning, and my whole calendar is like booked up with investor calls. So now, before that was a huge pain point too. I just trying to go back and forth with one investor, scheduling a call would be like, would take days. And so automating that process, what John said, creating systems, a lot of that will help ease all of that, so that by the time someone moves through your funnel, they've already interacted with you in various ways, and they've already gotten to know you to a certain degree that by the time, you actually hop on the phone with them, you spend time talking about important things. So every time I hop on the call with an investor, they say, oh my gosh, I've spent so much time on your website, reading your blogs and watching the videos, and I feel like I've learned so much. And so it's great because now we're not talking about, what's an 8% preferred return, or, who are the players in the deal, or how does syndication work, and all these very, general questions. All of those questions have already been answered. So now we can really spend time digging in and getting to like the heart of their questions that is allowing us to convert them into an actual investor. And so, for us, having all of that front loaded and automated has allowed us to then spend, more time getting to know them on a very intimate level, which then actually converts them into an investor.
Yeah, it's pre-qualifying them before you get on the phone. We didn't do that before. We talked to every single person that came through the website. And in some cases, we're not going to talk to people right now, frankly, because of time, like to John's point. But if you pre-qualify them, ask them a half a dozen questions, you get an idea whether they're, potentially a good fit or not. Those are the people you want to spend time with. If you have time to do the rest, go ahead and do it. But chances are you'll get to a point where you just can't call every single person that comes through your site. And in some cases, they really don't have any, they're not going to provide you any, say, financial benefit or business benefit because they don't have any money. People come up there, I say, I'm totally broke. They say, Phil, I'm totally broke. I have no money. I don't probably want to get on the phone. I'll put them in the funnel. They can get some stuff from us, but I'm not going to jump on a call with them.
And that's a good point. And I'm just saying, and then you can qualify them in the form. You can say 50,000 minimum, and they have to select an option. And if they don't select an option, they can't submit the form. They don't have $50,000 to invest, and they'll never actually get into your funnel at all.
That's right.
Yeah, I think that our time is the biggest and most valuable thing we have in our business here, and we want to maximize it. And so I'm trying to kind of outsource any sort of like administrative tasks, or try to kind of, put systems in place and processes in place that can take some of the workload off of what I do so that I can spend time on, those meaningful conversations with new investors or repeat investors. And I would say on the front end, yeah, so there's a lot of investor calls that happen, especially with new investors. But as they, learn more, get more comfortable, and then do a deal or do multiple deals, it gets a little bit easier with repeat investors because they kind of know and understand it. And they're great, sales force for you as well, because they're bringing in, typically I see a lot of people when they invest, they've got friends that invest with them. And so that's been great to kind of see. And it actually, it speeds up the process a little bit because they are already, they're spreading the word about what you're doing and their experience they're having. And so when someone comes in from that, that perspective, it's a much easier conversation. And, they're somewhat, pre-qualified from the friendship and the relationship you have, and they know kind of the criteria and how the deals are structured. And so, so those are types of conversations I enjoy having. But yeah, a lot of times it's also filtering out like who comes to your site. Like I've had people come to my site that aren't investors. They just want to sell you something. And so I have to weed out those people. I don't even respond to them anymore because it takes up my time, and it's frustrating because they might appear to be an investor, but they're just wanting to sell you something, and you just wasted a half hour of my time where I could have been talking with someone else. And so in those situations, I'll wait for someone to follow up with me multiple times. And then if there truly is something of value there that would make sense to talk, then I'll set that up. But I think getting, some guardrails around however you can, before you have that conversation, just knowing a little bit more about that investor, because you could be spinning your wheels on a conversation that maybe you shouldn't be having.
Oh yeah.
Yep. So another question is about investor relations. Obviously, that's kind of what our topic is right now, is about newsletters. And I know each one of you have newsletters that you guys send out to your investors and various things like that. So the first question is do you send out newsletters? And the next question is, because this has actually come through a couple of different questions in different ways, is which platform or software do you use to be able to email out, track those people, and manage your investors?
So content and technology are the two major issues that I hear syndicators having. What should I write about? Not a writer. What technology should I use? I'm not really a tech person. And those are two real problems, right? So on the content side, you can get as easy as going out on the web and and basically sharing relevant news that's relevant to an investor. Like if you're not going to create content, then go aggregate it somewhere. There's a lot of news sites, about stocks, about oil, precious metals, the economy, and basically, compile a best of for that week and then email it out. Ideally, though, you're producing some kind of content, something that's relevant to your investors. And the best place to get ideas for that is as you get questions when you're talking to investors on the phone. If you haven't written a blog post or video, then you can answer that question. Pick one of the media that you like. So if you love to write, then pick blog. If you like to be on video, do video. If you like audio only, then consider doing a podcast, right? So the thing is, though, you got to commit to doing it on a kind of a weekly basis. On the technology side, I think John and Ryan, you guys are using MailChimp. We are using something called ActiveCampaign. Yep. ActiveCampaign is it's actually relatively easy to use. It sends emails pretty easily, but what it does, that's just the tip of the iceberg. What it does is it allows you to do conditional processing on the back end, to tag people, and based on behavior and what they've done, you can then present them with different kind of content. So for example, if you've had a conversation with them and you declare them, quote, deal ready, well, now you can present the deal to them. Otherwise, if they're in your funnel and they haven't scheduled a call with you, you don't know who they are, you probably shouldn't be presenting them a deal with them. So it allows you to do these kinds of things.
Yeah, we ActiveCampaign as well. ActiveCampaign and ClickFunnels.
Yeah.
Tool was.
Yeah, we use ActiveCampaign too. It's very robust. I used MailChimp before, and it doesn't have a lot of the back-end automation funnels that allow you to just like with a click of a button and, setting up a few automations, like all of these things can happen very easily to direct it at the, right people. And it also works very nicely together with like Excel spreadsheets and all kinds of things. So you can literally have like buttons in your newsletters or in your campaigns that will then, lead to a form, which then will compile all of the information in an Excel spreadsheet for you on the back end that the investor never sees. So I don't know if MailChimp can do that, but that's like one of the many things that ActiveCampaign can do. We absolutely do a newsletter, and we also try to focus on, content. So we write blog posts and we, release them on a weekly basis there. But I would say another good thing to do is that if you have a particular market that you like to invest in, include information there about the growth that's happening in that market. So for us, Dallas-Fort Worth is a huge market. And for us, we're, where we have like majority of our portfolio. And so I would say, every now and again, we'll just like sprinkle in the newsletters, like, hey, here's the latest news on the Dallas-Fort Worth area and the growth that they're having there. And, it really helps to encourage investors and, spark their interest and get them excited about the markets that you're interested in. So that's another avenue, just to kind of piggyback on what Michael had said earlier on what he puts in his newsletter. So, yeah.
Yeah, we currently do one monthly newsletter. So what we add a favorite article of the month, and we always add a soft commit button at the end because you never know who forwards to who. And yeah, that's that. And we use MailChimp. But as you guys, whoever asked this question, as you start going down this rabbit hole, you're gonna notice, you're gonna hear about ActiveCampaign. I've already had a call with them, so we're already ready to transition when we get to that level. And you always are ready to transition to the next best tool that's going to benefit your business. So yeah, that was a great question. Great question.
Yeah. And I would say that the same thing too. I mean, I use MailChimp, but I also have Pipedrive as kind of my CRM system. And then it has to kind of link up through like Outfunnel. So it's not probably as streamlined as maybe the ActiveCampaign could be. And so, yeah, I've been interested in that, looking at that. And so far I've got, it figured out to where it functions and does what I need it to do. But as I continue to grow, there's more features and things like that I think could streamline things that, I just need to invest into to make sure that I can get even more efficient with how I manage everything.
That's all it's about, efficiency at the end of the day.
Yeah.
All right. So another question here is about how you guys help your investors learn more about you and your experience when you speak with them when you speak with them either on the phone or in person. What are some things that you do to help them learn more about you?
I just share my background and my story. I mean, I tell them we're in this together. This is like, to me, I've got a sports background, so this is like a team sport. We're all participating, maybe a smaller piece of a larger deal, but we're all in this together. It's not like they invest in a deal and the relationship goes away. I mean, we're there through the whole life cycle of this. And so I just tell them, I typically, was in a position that they're in today. If they were a working professional, I mean, I was in that position and I built enough passive income on the side through investing in these real estate syndications to walk away from that. So I feel like I've got a story that, worked for me that most investors, that I talk to, that's what they want. They want the freedom and flexibility of investing through these real estate syndications. And so that's a big reason why they do these deals. And I look at myself, I'm living proof. I did it, and I did it in a very short period of time. But it took, many years in the corporate world of making good money and being smart with it to be in a position to actually have the capital to invest. Then I was able to do it in this structure. It really changed my life. And so I love to share kind of what I went through, because for the most part, a lot of people tell me that's what they want too. And so I can answer any questions around that process and kind of show them how I did it and give an example or two of, how it all played out. And so I try to talk about them, but a lot of times that, they're asking, or, to kind of Julie's point, they've seen a podcast or a blog or listen to a podcast. They kind of maybe know my story, and they might just have a few, more detailed questions around that. And so I can then really kind of pinpoint and maybe share it from that aspect. So I think it's the best thing you can do when you're building relationships with people out there, is to let them know, like, hey, it wasn't easy, but I did it, and you can do it too. And here's how this process works.
Yeah, I'd say too, and it was, doing IT as IT before, I was CPA before that. So from a interaction standpoint, all I really cared about is fixing problems. And end of the day, people, yeah, they want to know about your background, but they actually kind of want to know you. They really do. I mean, I never realized as much as I do now that, so if you have certain data points that are the same, like, hey, I have people reach out to me because of my twin. Like literally, I only reach out to you because you have a twin. Oh, okay. Strange. How they know I was a twin? Well, they heard it on a podcast or whatever, school I went to, or someone starts talking about motorcycles. My son's a motorcycle nut. I'm not really necessarily, but I can still talk to people about that. So, or missions. People say I reached out to you because I just felt like because of missions you're doing, things like that. So there's so many data points. We all, not all. I always try to keep business. Like, why do I care about anything else? We're wasting time talking about that. So I used to think I'll just get to business. And reality is people do want to know about you, potentially your family, your, what you've done, and things like that. So I just say don't keep it all business necessarily.
It's about being relatable. So what my story was 5 years ago, I'm not going to share the whole story, but 5 years ago, I looked at my 401k and projected it out. That's it. That led me down to this rabbit hole. Everything I read led me back to real estate. Then it went from single family homes. Then it said, how do you scale multifamily? Now I'm here. So everybody can relate to that. So that's how I share it.
I think, especially when you're starting out, one of the major problems you have is a lack of track record, right? And so it's very, very important that you have a team around you. And it's the same thing for all of us. It really is a team sport, and regardless of what level you're at, right? So if you're just starting out, when someone calls you up and you really want to talk about the team, and you better have some really experienced people on your team, property managers, attorneys, possibly, a senior partner that you're aligning yourself with. And if you're a capital raiser, hopefully you've aligned yourself with a senior partner. You can talk about them more so than yourself. Now for us now is, obviously we have some track record now, but it's also really about the team. So when someone schedules a call with us, really go through great lengths to talk about, yes, our track record, but really who's on the team, like who's doing what's their background. And so they get to know not just one person, but they see that there's a team there and the experience that we have on there. So we rely heavily on the team as anyone, really at any level.
Yeah, and I would say for me, it's very much the same as Ryan's story. In what he shares with his investors is just sharing my background. 3 years ago, I was commuting 2 to 3 hours a day on the road, and I was working a full-time job, and I have 3 kids, and life was crazy. And, very similar, I was determined to figure out a way out of that. And, a year and a half later, here I am, listening to Michael Blanc's podcast and, various other ones, but, it's listening, consuming as much information as you can to, try to get yourself out of that. And when I share that story with investors, it resonates really deeply with them, because that's what they're looking to do as well. And they're at some point on that spectrum, whether they're all the way at the beginning and they're just starting their journey, or maybe they've already started listening to podcasts and reading books and things, but being able to share that story helps build a bridge between the investor and I, and helps them feel like, they're getting to know me and we're similar and we have similar goals, and, they feel like they can look to me for help. And so, yeah, that's something that I do that's worked pretty well.
One of the other things that I would also tie this up with as well is, our group just recently went to a video recording studio, and we just ended up recording a video as an introduction to our group in our team, so that, because what I was finding is, like we talked about earlier, one of those valuable resources we have is time. And I was spending, I'd schedule a 30-minute call with some of our investors, and I'd spend the first 10 minutes discussing our team and how each one of the partners play a different role and what their backgrounds are. And it was getting very monotonous for me because I was taking, 10, 15 calls a day and going through that same thing. And you guys all know what I'm talking about because you probably have done that before. And so we're trying to figure out what is a way for us to let them get that information before they jump on a call with me, so that call could be more purposeful about them than just talking about us. And so what we did as a group is we all 3 went to a studio and we all recorded a segment on our own backgrounds and bios and what our roles are in the group. And that actually is now my assistant, when somebody reaches out to us on our website, reaches out to each investor, calls them first, and then also puts them on my schedule. And when they get the schedule, they actually get an email from us that basically says, here, watch this short, 5 to 7 minute video about our team and our group, so you can have a little bit more information about us before you jump on a call with us. And so that's another thing that we've done that has helped us be able to, allow them to learn more about us before we actually jump on a call with them.
That's great.
So we have only about 5 minutes left. So these last 3 questions, I'm just going to call on just somebody in the group to answer the question, so we can kind of rapid fire some of these, and then we'll tie it up towards the end with the last question that I have for you. I will bring this to Mark. Can you speak about an acceptable range for how much sponsor equity you should ask for in a deal?
Sponsor equity, acceptable range, we do 70-30 splits. So we don't do waterfalls. You can do more than that. If you do a clean without a pref, I would say 20% is what I've seen most common. If you do a pref, it's pretty common to have 30%, and then your waterfall could be up to 50% of the, depending on the IRR hurdle or equity multiple or whatever you're doing it on.
And the next question I will have is with Julie. When raising money, do you segment out the types of investors that you have? Like, you have a list for, your accredited investors and a list for your sophisticated investors. And do you market to them differently and communicate to them differently? How do you segment them out?
Yes, we do. We have them segmented out. So anytime I have a phone call with someone, I tag them in active campaign as, non-accredited, sophisticated, accredited. And yeah, we will communicate with them differently depending on the types of offerings that we have. Sometimes what we used to do when we have very limited spots is, you can only have 35 non-accredited investors on any given deal. So when we have limited spots on a deal, and we as a company only have certain, allocation that we can raise for, sometimes what we'll do is we'll send out the deal actually to the non-accredited investors first to give them, first chance at the deal. And whenever I talk with the non-accredited investors and tell them that that's how we do it, it always makes them feel a little bit of a sense of relief, because they feel like then they get a little bit of extra time to evaluate whether it's, a good deal, whether it's something they want to do. As far as like content goes and the marketing, no different. It's it's the same deal, same team, not really anything different. Maybe we'll share, some different aspects about the deal that might be, beneficial for someone who's non-accredited or just getting started. But I would say no, for the most part, it's pretty much the same.
And Michael, this was the last question on our Q&A box I'm going to ask you is, how likely is it to get you to jump on a podcast and be a guest for someone else? It seems like you already have your own podcast.
Oh, if someone wants to interview me, is that the question? Hey, reach out to me. Yeah, absolutely.
They're just saying, how likely is it for them to get you to be on their podcast, I guess?
Oh, well, it's very possible. We'll see. I'm going to be on vacation early July, and then we have our live event. So July is out.
I would say that for the most part, all of us, even including myself, it's fairly easy to reach out to one of us and say, hey, we'd love to have you on the podcast. Because for us to be able to spend, 30 minutes to an hour on somebody else's podcast, no matter what size that podcast is, it's still beneficial. And it's a very small amount of time that can continue to pay dividends for the future.
Yeah.
So the last question that I have is, go ahead and just probably like a, very short 1 to 3 sentence thing here, if you can. What is one piece of advice that you would give anyone getting started with raising capital?
I'll take that one first, I guess. It just goes back to everything that I have talked about. I feel like I've kind of like reiterated over the time we've had today. But it's just going back to adding that value. It's really about doing that unrequired work, up front, ahead of time. For me, I did my first deal as a passive investor, and then I probably spent the next 6 or 7 months just talking with people, friends, family, other mothers about, what I had gotten into. There was no deal in front of me. I didn't even know that I was going to jump over to the active side on the GP side of the deal. And so it was really just, adding that value ahead of time and doing the work that was not required of me.
My advice is to talk to everybody. Like we said, talk to everyone intentionally. And what that does is allows you to practice and gain confidence. And the more you gain confidence, the more people are going to want to invest with you. So my advice is just talk to everybody.
Yeah, I would say is good as well as maybe raise capital on somebody else's deal that already has a track record, and you come in and you leverage a track record.
It's good.
Yeah, I would say find the right partners to work with. Find a mentor, someone out there that maybe is doing what you want to do, and learn from them, learn from others' mistakes, and just surround yourself with good people that are willing to help you, and always be building relationships. I mean, that's the number one thing that I've seen out there where people have had success, is just building their network and building deep relationships. So never lose sight of that, and always be out there learning, be curious, and life will be good to you.
Yeah, I always suggest invest in someone else's deal and get paid to learn. So I always use that. And there's another, I kind of had it at the beginning where Julie was talking and I lost it. It'll come back. If I do, I'll message it in that box.
Well, I want to thank each one of you for being here with us today. And as we're wrapping this up, I want to share just one more time how everybody can reach you. So if you want to reach Julie Lamb and continue a conversation with her, you can go to goodegginvestments.com. Michael Blanc, you can go to nighthawkequity.com or themichaelblanc.com. And then for Mark Kenney, you can go to thinkmultifamily.com and reach out to him there. Ryan McKenna, you can go to mckennacapital.com. And then John Fortes, you can go to cfigwealth.com. And yes, I was not looking at any notes, and I remember every single one of those websites.
That's good.
That's pretty cool.
Thank you guys so much for being here with us, and looking forward to continuing to kind of follow you guys as you guys continue to grow your businesses.
Thanks, Dan.
Thank you, Dan.
Thank you, Dan.
Appreciate you.
All right, I'll have you guys go ahead and just turn off all your cameras there, and as well as your mics. I'm going to wrap it up here. The next session that's coming up into room 1 is going to be Trevor McGregor, the rapid process, how to talk to investors so that they invest in your deals. In room 2, this is going to be at 2 p.m. We're going to be starting back. We'll be talking with Jillian Sidoti, who is going to be talking about the SEC regulations for raising capital. And then in room 3, there'll be expert underwriting tactics for multifamily properties with David Tupin. So make sure that you figure out which one of those you want to be a part of. And during this break, make sure you go to nextmfin.com and register for the January 2020 event. You'll also be entered into a drawing for an iPad. We have 3 of those that we're giving away this weekend. So make sure you go register now. It's only $97. Just like you said in January when we did this same thing, you will not be able to get it any cheaper than that. So go to nextmfin.com and register for your ticket to the January 2020 event. And then also, if you can get another entry into the drawing for the podcast. For the iPad by going to iTunes and registering for the Multifamily Investor Nation podcast. Subscribe to that, and then also when you subscribe to that, take a screenshot of a review that you post on that podcast and send it to Stacy at multifamilyinvestornation.com, and she will enter you. You'll have another entry into that drawing for the iPad. So thank you guys so much. We're going to take a quick, probably 12-minute break here, and we'll be back shortly.